Welcome to the Deep Dive and our Talk Tickers segment. We break down the latest earnings calls so you don't have to.
That's right.
Today we're jumping into General Mills. They just had their first quarter fiscal 2026 call on September 17th.
Yep, lots to unpack there. A real mix of signals, I'd say.
Definitely. So the big question we're looking at is, can this huge company, General Mills, really pivot? Are they making the right moves for growth? Or is the market right to be a little bit skeptical right now?
Exactly. Because the market reaction was, well, a bit muted, wasn't it? Shares dipped slightly. It shows this kind of cautious optimism, maybe leaning towards cautious.
A show-me story. So let's start with that quick summary, the headline numbers. What really jumped out from the results?
Okay, so first glance, GAAP earnings per share looked amazing. $2.22. That's up 116%. Huge jump.
Wow. Okay. But there's a but, right?
There's a big but. Most of that, a huge chunk, $1.05 billion, came from selling off their yogurt business.
Okay. So divestiture gains. What about the actual operations? The adjusted number?
That tells a different story. Adjusted EPS was $1.86. Now, that actually beat analyst estimates by about 5 cents, which is, decent.
Some resilience there.
Some resilience, exactly. But it was still down 20% year over year in constant currency. So operationally, definite pressure.
Okay, so strong headline from the sale, but underlying pressure. How did revenue look?
Revenue landed at $4.52 billion. That was pretty much right in line with expectations.
No surprises there, then?
Not really on the top line itself, but that number represents a 7% reported decline and, importantly, a 3% organic decline year over year. So less volume or negative price mix going through.
And profitability beyond EPS, like operating profit margin.
Yeah, those took a hit, too. Adjusted operating profit, down 18% in constant currency, came in at $711 million.
Yeah.
And the adjusted gross margin slipped 120 basis points.
Ooh, 1.2 percentage points.
Yeah, down to 34.2%.
Yeah.
Management pointed to, reinvestment and some inflation as the main culprits there.
Okay, so pressure pretty much across the board operationally. Were there any parts of the business holding up better, segment-wise?
Yeah, it was definitely a mixed bag. North America, retail, NAR, their biggest segment, the stuff you see most at the grocery store, that had a really tough quarter. Net sales down 13%.
13%. That's significant.
It really is. Food service was also down about 4%. But, and this is key, the pet segment and the international segment were the bright spots. Both grew net sales by 6%.
Okay, so pet and international showing strength. That kind of fits the narrative of where they're trying to shift focus, right?
Absolutely. It shows that portfolio rotation is starting to bear some fruit, even while the core U.S. business faces these headwinds.
So let's dig into that strategy then. What's the big plan for fiscal 26? What are they telling investors?
The core message, the central theme, is all about getting back to volume-driven organic growth, not just relying on price increases.
Okay, wow.
We've got this thing called the Remarkable Experience Framework. Fancy name, but basically it means investing more in consumer value, so maybe better pricing, promotions, but also innovation, new products, and just better brand building, advertising quality.
Making the brands more appealing beyond just the price tag.
Exactly. Trying to give people more reasons to choose their products and maybe buy more of them.
It makes sense. But with NAR down 13%, how confident did management sound that this remarkable experience thing is actually working or will work soon?
Well, the CEO expressed, increased confidence. They pointed to some positive early signs from price investments they'd already made in brands like Pillsbury, Totino's, cereal, soup, fruit snacks.
Seeing results there?
They said they held or gained pound share, so actual volume, in 8 of their top 10 U.S. categories within NAR. That's important. Even if dollar sales are down because of pricing, holding volume is key to the strategy.
Right, stopping the volume bleed first.
Exactly. And they saw sustained pound share in pet, strong performance in food service, and international too. Plus, and this is a big one, new product volumes are up 25% year over year.
Okay, that innovation piece seems to be getting some traction then.
It seems like it. It suggests the new stuff they're putting out is actually resonating.
So, given this mixed picture, Tef, Q1 operationally, but some positive signs, did they change their outlook for the full year? Fiscal 26?
Nope. They reaffirmed the whole thing.
Really? Okay. What is that guidance again?
They're still projecting organic net sales to land somewhere between -1% and +1% for the year.
Flat, basically.
Pretty much flat, yeah. And adjusted operating profit and adjusted EPS are both expected to be down 10% to 15% in constant currency. They're explicitly calling it a reinvestment year.
So taking the profit hit now to fund that remarkable experience strategy.
That's the plan.
Yeah.
They also targeted free cash flow conversion at 95% or better.
Yeah.
But they were clear Q1 profits were hit by these investments, the yogurt sale impact, and some timing stuff.
And they expect that to continue.
They do. They said expect Q2 pressure to be similar, maybe even a bit worse than Q1, but then significant improvement in the second half, especially Q4. It's a classic wait for the back half story.
All right, let's focus on that pain point then, North America retail, down 13%. You mentioned price investments and trade timing. Can you elaborate on what they're actually doing there?
Sure. So the price investments, they talked about adjusting shelf prices to get below key cliffs, hitting those psychological price points like $2.99 instead of $3.19.
Makes sense. And managing gaps versus competitors.
Right, making sure the price difference between their brands and private label or other competitors isn't too wide. They said they did most of this in Q1, finishing up in Q2. It's about finding that sweet spot for value.
And the innovation side in NAR, you said new products were gaining traction.
Yeah, that was a definite positive call-out. New products now make up about 5% of NAR net sales. That's up from 3.5% a year ago.
What kind of products? Any examples?
They mentioned Cheerios protein, some Moss bars and granolas, Cinnamon Toast Crunch variations, things that tap into current trends.
And the most encouraging sign you mentioned?
Household penetration. For the first time since fiscal 22, they actually saw growth in the number of households buying their NAR products. That's huge.
That is a big deal. Shows maybe the strategy, the combo of price and innovation is starting to work.
They certainly think so. They attribute it directly to those price adjustments and the whole remarkability approach, better ads, better products.
Okay, shifting to a positive story, the pet segment, up 6%. What's driving that?
So the core Blue Buffalo brand held its volume share, its pound share. Dollar share dipped slightly, maybe due to mix or competition.
Volume held.
Volume held. And they saw good growth in Blue Light Protection formula, also the cat food business, Blue Tastefuls, Tiki Cat doing really well. Treats also turned positive on volume.
Any weak spots in pet?
They did mention needing to improve the Wilderness line and their performance in the pet specialty channel, like dedicated pet stores.
Got it. But the big news in pet is the fresh food launch, right?
Oh yeah, that's the potential game changer. Blue Buffalo, fresh pet food, launching in the U.S. They're moving fast, aiming for 1,000 coolers in stores by the end of September, then ramping up to 5,000 by the end of Q2.
Wow, 5,000 coolers. That's a big rollout.
It is. But management sounded confident. They kept emphasizing their 50-plus years of experience in refrigerated logistics from Pillsbury and yogurt. They feel they know how to handle the cold chain.
Leveraging existing strength. And quickly, international and food service. International was up 6%.
It was, which is good.
Yeah.
But they did flag some timing benefits that helped Q1, suggesting that might unwind a bit in Q2. So maybe temper expectations slightly there.
Okay. And food service down 4%.
Down 4%, but they highlighted that they're still gaining share, especially in what they call the non-commercial channel, so schools, hospitals, businesses. That area is actually growing about 2%, while the broader restaurant channel is more stable. They're finding pockets of growth.
Interesting. So let's go back to margins and profitability. Q1 profit beat expectations slightly, but they expect Q2 to be worse. What drove that Q1 beat, and why the Q2 pessimism?
Right, so the Q1 beat had a couple of temporary helpers. Inflation wasn't quite as bad as they budgeted for. In Q1, came in around 2% instead of the 3% they expect for the full year.
Okay, a phasing benefit.
Exactly. And they also had a $20 million timing benefit on trade spending internationally. Both of those, they said, will largely reverse in Q2.
Ah, so the headwinds get stronger in Q2.
Yes. Plus, they'll face higher supply chain costs in Q2 from inflation and inventory effects, and obviously no contribution from the yogurt business they sold.
And trade spending in North America.
That was a drag on profits in Q1, expected to be a big drag again in Q2 as they fund those price investments. But the plan is for that to normalize in Q3 and actually become a tailwind, a positive contributor by Q4.
Okay, that phasing is really important to understand the profit trajectory through the year.
Absolutely critical. Near-term pain for that hoped-for back half gain.
Stepping back now, what about the bigger picture, the macro environment? How is General Mills thinking about things like the consumer or those GLP-1 drugs?
On the consumer, they feel the current volume pressure is mostly about value. People are still recovering from inflation. Wages haven't fully caught up for everyone, so value is king. They think they can address that with their pricing and innovation.
Makes sense. And GLP-1s, the weight loss drugs.
They acknowledged it, said it's a growing trend. It'll likely put some pressure on certain categories over time, sure. but they stress the impact isn't really significant for them yet.
But are they just watching it, or?
No, they actually see an opportunity. They talked about focusing on products high in protein and fiber, things that might appeal specifically to people using GLP-1s or just health-conscious consumers generally.
Interesting angle.
Yeah.
Turning a potential threat into an opportunity. What else on the macro front? Regulation.
Yeah, they mentioned the complexity of state-level regulations around food additives. They're pushing for a consistent federal standard, arguing this patchwork approach just adds cost and confusion.
That's a common industry argument. Anything else? Technology.
They did highlight improvements in demand planning using AI and tech. Getting better at forecasting means less waste, more efficient marketing spend, smoother supply chain. That could be a quiet advantage if they execute well.
Okay, so bringing it all together for someone looking at General Mills, what's the investor context here? What's the story arc?
The big picture is this massive portfolio shift, selling off slower stuff like yogurt, doubling down on growth areas like pet and international, while trying to fundamentally reset the core U.S. business NAR for volume growth, not just price growth.
And the main risk?
Execution in North America retail, absolutely. Those price cuts and new products have to translate into sustained dollar growth eventually, not just holding on to volume share. That's the hurdle they need to clear.
It's a shift from price mix driving results to needing actual volume to come back.
Precisely. It's a multi-year journey they're on.
So looking ahead through fiscal 26, what are the key things to watch? The catalysts or proof points?
Definitely watch that Blue Buffalo Fresh Pet rollout in Q2.
Yeah.
How quickly do those coolers get placed? What are the early sales like? Keep an eye on organic sales growth. Does it turn positive as they hope? We need more detail on cost savings versus inflation. And tracking their market share against private label, plus any real measurable impact from GLP-1s. Those are the big ones.
Got it. Okay, we've covered the quarter, the strategy, the context. Now for our favorite part, totally speculative, not financial advice, just a mental exercise. Based on this call, give us an outrageous but plausible trade idea.
All right, idea number one, the GLP-1 portfolio arbitrage.
Ooh, sounds fancy. Go on.
The idea is you construct a trade where you're effectively long the parts of General Mills' portfolio that could actually benefit from GLP-1 trends, high-protein cereals, fiber snacks, maybe even pet food, arguably. And short the parts that seem more vulnerable, think sugary desserts, traditional baking mixes.
So betting on internal divergence within the company based on GLP-1 impact?
Exactly. The market might be painting with too broad a brush. Maybe there's alpha in picking the winners and losers inside General Mills, driven by their own innovation and this macro trend.
Interesting. Playing the nuances. Okay, what's outrageous idea number 2?
Idea 2. The cooler CapEx conversion play.
Focused on the fresh pet launch.
You got it. Go long General Mills, betting specifically on the efficiency and success of rolling out those 5,000 Blue Buffalo fresh pet coolers by the end of Q2. Pair that with a short position in a pure-play fresh pet competitor, one that already has a massive cooler network, maybe 30,000 plus.
What's the logic there?
The logic is that General Mills, leveraging its existing refrigerated expertise, might achieve much better ROI and unit economics from its more measured, strategic 5,000 cooler rollout compared to a competitor who might have overspent, saturated the market, or faces higher maintenance costs on a huge, potentially less productive network. It's a bet on operational efficiency in a capital-intensive category.
Betting on smart CapEx versus just sheer scale. I like it. Definitely plausible, if a bit edgy.
That's the idea. Food for thought.
Great stuff. So, to wrap it all up, General Mills is deep in a strategic overhaul. They're investing heavily, prioritizing getting volumes back up, especially in their core U.S. market, while pushing hard into pet and international.
Yeah, profitability is taking a hit in the short term because of those investments and some macro factors, but they're signaling confidence for the longer run.
Absolutely. And remember, everyone, this conversation is purely for informational purposes. It is definitely not financial advice.
Please do your own research.
So think about it. What stands out to you from General Mills' strategy? Are they making the right calls, or is the market's current caution justified? Keep digging. Thanks for joining us on The Deep Dive.